Founded in 2005, Sprung Investment Management helps clients moderate swings in market volatility through a value investing approach. Aimed at preserving wealth and providing a real rate of return after fees and inflation, they are known for employing philosophies that run contrary to current investment trends. Sprung is different from other investment management firms in that they make a deliberate attempt to minimize trading and transaction costs and make decisions based on due diligence and staying the course rather than reacting to market volatility. In June 2014, we asked Michael Sprung about his current view of the economy.
Well, I think right now we're at a very interesting crossroads. Gwen Morgan was writing the other day in the Globe and Mail. He noted that Der Spiegel had an article about a week or so ago, and the headline was "Emerging Economies Hit a BRICS Wall." And he was referring, of course, to the BRICS: Brazil, Russia, India, and China. And the fact that those economies to some extent seem to have stalled, particularly Brazil, which we've seen their problems lately in getting the Olympics together. Russia, of course, facing all the sanctions. India, primarily lots of potential bad loans there and corruption. And China, of course, the slowdown in the economy and the overbuilding of infrastructure and so on of the last number of years, some of it not such great quality and so on. Whereas what we're seeing in the US economy is actually an expanding economy now, and on a absolute basis, the US is likely to contribute more to global GDP this year than China. So where the BRICS had a large surplus contribution before, now the sort of developed economies, including Britain and Germany and the US and so on, are actually going to have more of a contribution. So I think this is quite interesting because it affects Canada in a lot of ways. It affects Canada in terms of demand for resources. We're seeing more manufacturing in the US. Now the US is still our largest export partner, but we are depending more and more upon the emerging economies. You wouldn't know that to look at the stock markets today. To the end of last week, the total return on the TSX was still over 9%. Now we've pulled back a little bit since then, whereas the US had been closer to 4%, and the emerging economies, you were lucky to see 2%. So in terms of the stock market reaction, I think we're in a very interesting time here. And our view is that particularly in Canada, perhaps the fundamentals are a little bit ahead, the stock markets are a little bit ahead of the fundamentals here. So we would not be surprised to see a pause. Now, if we did see a pause, due to the fact that the US is picking up to the extent that it is, we think that could be an opportunity for investors to step in.
What is your view on the new strategy at Rogers Communications?
I think Rogers faces a number of issues and problems to get over. One of them is the backbone of their infrastructure in terms of technological ability. It appears to have stalled out relative to some of the newer things that are available vis-a-vis fiber. They do compete in the wireless world, but they've been having trouble. And they've defined their new strategy in terms of trying to get back both business and retail confidence, to try to reestablish themselves as technological leaders and to try to just regain some of the share that they've lost over the years. I think that they're going to have a tough time achieving that. Now they're adopting a structure that's not unlike we see in other telcos, but they're still going to have an awfully large executive suite. They're not only going to have sort of consumer, enterprise, and media, but with that they're going to have all of the other sort of corporate, human resources, legal, accounting, and so on. So it ends up with about 12 or more people still in that executive suite. And so I think it's going to be very difficult for them to achieve the turnaround that they're looking for, particularly in a short period of time.
There's been a number of Canadian banks that have reported strong earnings this quarter. Are there any other banks that you think will surprise on the upside?
Well, we're certainly hoping that tomorrow the CIBC will surprise on the upside. Now, so far we've seen Bank of Nova Scotia, Royal TD, and National report. Certainly with the exception of National, I think the results were far ahead of expectations. And where the real surprises came in a lot of people have been talking about the headwinds in credit and the debts of consumers, and yet we're seeing provisions for credit losses, at least the ratios, remain relatively low. And so credit has been surprising on the upside. Net interest margins in this environment to a great extent have been expanding. We're seeing great results out of international banking, and capital markets have surprised more on the upside than the downside, particularly with respect to trading and so on. Now, we own exposure to Royal Bank of Nova Scotia and CIBC. I think tomorrow when CIBC reports, people are going to be looking very closely not only at the credit situation, but also the success of their new credit card program since they lost AeroGold to the TD. AeroGold did contribute somewhat to TD's results, but I think this new Adventura card that CIBC has come out with is going to surprise people on the upside as well. So overall, we're expecting to probably have fairly healthy results out of the CIBC tomorrow, and we look forward to seeing that when it happens.
Do you anticipate that merger and acquisition activity is going to pick up in 2014?
Yes, we do. We anticipate that M&A activity is going to pick up for a number of reasons. We're in a slower growth world than we were in previous cycles, and in order for companies to grow, I think they are going to depend more and more on M&A activity to achieve that incremental growth. And I think we're already seeing it in a number of areas, energy being one, but we're also seeing it amongst pharmaceuticals and other companies today. In a world where GDP growth is going to be much lower, around 2.5–3%, in order to achieve that, anything beyond organic growth, we're going to see a much more dependence on mergers and acquisitions, and so that should make the investment bankers quite happy.
What sectors do you currently like?
Well, in terms of places where we continue to find value, I'd have to say that despite the fact that energy has been amongst the best performing sectors of the TSX so far this year, we're still finding relatively good value. I mean, energy as a whole has been up about 14% year to date, and despite the fact that we've seen natural gas prices increased by about 12%, which I think has surprised people on the upside. However, West Texas Intermediate, for instance, is only up about 3.5% year to date. And we've seen a lot of the stocks beginning to run, I think largely as a result of a number of the production increases that we're beginning to see, particularly in the US. And that is also contributing to the efficiencies in the economy to some extent, particularly on the manufacturing side. So in terms of exposure, we still today, like Encana for instance. Now Encana has really surprised people with some of the things that they have done in terms of the recent issue of Prairie Sky at prices above what anybody thought that they might be able to sell that at. That's been a great surprise. Spinning out of the royalty business in Clearwater, the purchase of the large tract in Eagle Ford, I think, has also been a particularly positive surprise to the market. And we expect going forward that will continue to be reflected in positive results in the share price, at least over the next number of years. We also think that the dependence on natural gas may get down in the next couple of years to about 75% of production from the 85% where it currently is. We also like Cenovus because this is a company where you have fairly predictable production increases over the next number of years. The capital going into it, again, they've managed to maintain the costs of that oil sands development to a great extent. It's a very efficient company, a very efficient management, and they do have both upstream and some downstream assets as well. And then finally, of course, Suncor, which has been a long-term holding of ours, which is more of a fully integrated play, but again, good balance sheet, great management, and again, expanding production over the next number of years. So we like all three of those, and we'll continue to hold them.
Do you have any favorite small cap companies you'd like to mention?
Yes, occasionally we do go down into the smaller cap, in fact, what people might even consider almost micro-cap. One exposure we have is to Temple Hotels. Now, 8 of the 21 hotels that Temple owns are in the Fort McMurray area, and given the limited expansion available there, they have quite a lock on that market. They also have been very aggressive acquirers of hotels in other areas, primarily out west. We see this as a company that, today you can buy for a roughly 8 times available funds from operations. It used to be a unit trust, so we still tend to look at it that way, and yet it carries a very healthy yield around 8.5%, which reflects a payout ratio of about 75%. So I think that's quite sustainable. So there's a company that we've done very well on that I think we will continue to hold unless it appreciates quite dramatically from here. Another example would be Alaris Royalty, which is a more recent purchase of ours. This is almost like a private equity firm, but rather than take equity interest directly in companies, they issue preferred shares which escalate in terms of their payouts provided certain benchmarks are made, and if they don't, then it can convert into real equity. So they have had an expanding dividend over the last 5 years, and we suspect that that will continue to expand. They currently have 12 investment partners, the largest of which represents about 17% of their funds coming in. They plan to reduce that to about 10% in the not too distant future. So we're seeing a diversification amongst healthcare, industrial, retail, other areas. They tend only to invest into private companies which have good long-term 10-year track records at least. And so I think it's been a very, very smart management team that has designed this company, which is very, very lean at head office. So again, it's currently selling under $29. I think anything under that level, it certainly could represent a good longer-term purchase.
Thank you for taking the time for the interview today, Michael.
Thank you.
Keep up to date with all of your favorite small caps. Subscribe to our free newsletter and get daily investment ideas, breakout stocks, momentum gainers, expert and analyst stock picks, and more. Smallcappower.com, investing ideas and research.